Hello everyone, this is Dr. K. Jagannayaki, Professor in MBA Department, Institute of Aeronautical Engineering, Hyderabad. So, in the financial accounting and analysis, there is one more important concept, that is DuPont analysis. After completion of this particular topic, the learner will be able to understand the concept of DuPont chart, what are the components of DuPont analysis, methods of DuPont analysis, drawback of DuPont analysis. Coming to the introduction to DuPont analysis, DuPont analysis, it is a formula which is used to track a company's financial performance. By using some components of the financial aspects, one can able to find out what is the real status of a particular company in terms of its financials. So it was developed in 1914 by F. Donaldson Brown, who worked for the DuPont Corporation. His formula incorporates earnings, investment, and working capital together into a single figure that he called return on investment. So with the help of this DuPont analysis, we can able to find out what is the return on investment. So it became a standard measure for all DuPont departments and was adopted by other companies. Understanding the DuPont analysis. DuPont analysis, it is a framework for analyzing fundamental performance popularized by the DuPont Corporation. It is a useful technique which is used to decompose the different drivers of return on equity. The decomposition of ROE allows investors to focus on the key metrics of financial performance individually to identify strengths and weaknesses. If you see this diagram, ROE is decomposed into three different components. One is based on net profit margin, and what will be the assets turnover ratio and equity multiplier. So, with the help of three, the company can analyze each of these components individually, and as a result, they can also collectively assess the firm's financial performance. A DuPont analysis is used to evaluate the component parts of a company's return on equity. This allows an investor to determine what financial activities contribute the most to the changes in ROE. So with the help of this ROE, one can able to find out if there is a small change in any of these three components, how it is going to have its influence on the overall financial performance of the company. So an investor can use tools like this to compare the operational efficiency of two similar firms. So managers can use DuPont analysis to identify strengths or weaknesses that should be addressed. There are three major financial metrics that drive ROE, return on equity. The first one is operating efficiency, which is represented by net profit margin or net income divided by total sales or revenue. And second, assets use efficiency, which is measured by the asset turnover ratio. And third one is financial leverage. It is a metric that is measured by the equity multiplier and which is equal to average assets divided by average equity. So with the help of these three factors, the company's ROI can be assessed by the investor before going to invest in any of the investment options. Coming to the formula and calculation of DuPont analysis, it is an expanded return on equity formula calculated by multiplying the net profit margin by the asset turnover by the equity multiplier. So DuPont analysis formula is it is the product of net profit margin and asset turnover ratio and equity multiplier, where net profit margin derived by the formula net income by revenue, and AT stands for asset turnover, which is computed by the formula asset turnover is equal to sales divided by average total assets, and AM stands for equity multiplier, which is calculated by using the formula equity multiplier is equal to average total assets divided by average shareholders equity. Coming to the components of DuPont analysis, DuPont analysis breaks into ROA into its constituent components to determine which of these factors are most responsible for changes in ROE. The first one is net profit margin. The net profit margin is the ratio of bottom line profits compared to total revenue or total sales. This is one of the most basic measures of profitability. So, with the help of net profit margin, we can assess what is the profitability position of the company. For example, net margin is to imagine a store sells a single product for $1. After the cost associated with buying inventory, maintaining a location, paying employees, taxes, interest, and other expenses, the store owner keeps 0.15 in profit from each unit sold. So this means that the owner's profit margin is 15%, which can be calculated as follows. Profit margin is equal to net income by revenue. So net income, which is generated earned by the shop owner or store owner, is 0.15, and divided by total revenue generated by selling a single product is $1. So if you simplify that, we'll get 15%. So this is the total profit margin earned by the store owner. The profit margin can be improved if cost for the owner were reduced or if prices were raised, which can have a large impact on return on equity. So this is one of the reasons that a company stock will experience high levels of volatility when management makes a change into its guidance for future margins, cost, and prices. So, if there is due to changes in terms of the future margins, even the cost of the product, the prices of the product, that leads to change in profit margin. So, it depends upon what is the net income and what is the total revenue generated by the company. Then second component is asset turnover ratio. The asset turnover ratio measures how efficiently a company uses its assets to generate revenue. For example, imagine a company had $100 of asset and it made $1,000 of total revenue last year. The assets generated 10 times their value in total revenue, which is the same as the asset turnover ratio and which can be calculated by the formula assets turnover ratio is equal to revenue divided by average assets. So the revenue what the company generated is $1,000 divided by average assets $100. So the total asset turnover ratio it becomes 10. The third one is financial leverage. Financial leverage or the equity multiplier is an indirect analysis of a company's use of debt to finance its assets. Assume a company has $1,000 of assets and $250 of owner's equity. The balance sheet equation tells that the company also has 750 in debt. So that can be derived by using the formula assets minus liability equal to equity. So if the company borrows more to purchase assets, the ratio will continue to rise. The account used to calculate financial leverage are both on the balance sheet. So analysts will divide average assets by average equity rather than the balance at the end of the period, and this can be represented as given below. Financial leverage is equal to average assets divided by average equity. So average assets, that is $1,000, divided by average equity is $250. Therefore financial leverage is equal to 4. And coming to the drawbacks of using DuPont analysis, the biggest drawback of the DuPont analysis is that while expensive, it still relies on accounting equations and data can be manipulated. In addition to this, the DuPont analysis lacks context as to why the individual ratios are high or low, or even whether they should be considered high or low at all. Let us take one real world example. So let us consider Walmart. For the fiscal year ending Jan 31st, 2022, the company reported the net income over the trailing 12 months of $13.7 billion, revenue of $572.8 billion, assets of $244.9 billion, and shareholders' equity of $83.3 billion. Use the information above to deduce that the company had the following. So, using that data of Walmart, now we are going to find out what will be the profit margin of Walmart, right? The profit margin of Walmart is 2.4%, or simply we can say net income is $13.7 billion divided by revenue, that is 572.8 billion. So by using this we can find out the profit margin of Walmart, that is 2.4%. The next component of ROI, that is asset turnover ratio. So assets and turnover ratio of Walmart is 2.34, which is computed by using the furnished data revenue divided by assets. So total revenue is $572.8 billion divided by asset value is $244.9 billion. So by simplifying this, we'll get the asset turnover ratio, that is 2.34. The third component of ROE, that is financial leverage, it is also known as equity multiplier, and it can be derived by using the formula revenue divided by shareholders equity. So the revenue of Walmart is the assets of Walmart is $244.9 billion divided by $83.3 billion. Then the financial leverage of Walmart is 2.94. So according to these figures, Walmart's return on equity for the fiscal year was 16.5%. So this simply multiplying all the three components like profit margin multiplied with asset turnover multiplied with financial leverage, then we can able to find out what is the Walmart return on equity. So it is identified that Walmart ROE is 16.5%. Then coming to the difference between 3-step and 5-step DuPont analysis. So in case of DuPont analysis, there are two versions. One is utilizing decomposition of ROE via three steps, and another one utilizing five steps. So under three-step equation breaks up ROE into three very important components. As we know, one is profit margin, second one is asset turnover ratio, third one is financial leverage or equity multiplier. So ROE is equal to net income by sales, which is multiplied divided by, into sales divided by assets into assets divided by shareholders equity. So if you do that, then we used to have three components, basically net income, assets and shareholders equity. Whereas in case of five-step version, we used to consider five components. So ROE is decomposed into five components. One is EBT. EBT stands for earning before tax, and S indicates sales. A stands for assets. E stands for equity, and TR stands for tax rate. So that is the basic difference between three-step and five-step version, is only the components what we are going to incorporate in the ROE formula. So that makes the difference. So any company, they may easily assess their return on equity by using DuPont analysis. Thank you.
Like, share and subscribe. Hit the bell icon for more updates.